Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Mongolian Mining Corporation Annual Report. Mongolian Mining Corporation offers a diverse range of businesses and services. At the core of its operations are mining activities, including the extraction and processing of coking coal products for sale in China. The company owns two key open-pit mines, Akakudeg and Barun Naran, both located in Mongolia's South Gobi province. In addition to mining, Mongolian Mining Corporation is involved in various infrastructure projects. These include the management of railway projects, operation and management of airports, as well as water exploration and supply management. The company also oversees power supply project management activities, further expanding its reach into Mongolia's infrastructure development. Beyond these core services, Mongolian Mining Corporation engages in coal trading and machinery equipment trading. This comprehensive approach to business allows the corporation to play a significant role in Mongolia's mining sector and beyond. Mongolian Mining Corporation market capitalization of 11 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Mongolian Mining Corporation holds a significant advantage in their industry. Mongolian Mining Corporation trades at a higher price-to-earnings ratio of 18 times and a higher price-to-book ratio of 1.18 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in the given scenario can be attributed to several key factors. On the positive side, a significant increase in total coal products sold from 8.6 MT to 10.1 MT has contributed to an 83% rise in revenue from $1,039,852 in 2024 to $1,823,398 in 2025. This substantial growth is a testament to the company's ability to expand its market share and increase sales. However, on the other hand, there are also factors that have led to a decline in revenue. The coking metallurgical coal operations generated $792.1 million, a decrease of $247.8 million from 2024. Furthermore, a significant drop in average selling price, ASP, for coal products by 32% year-over-year has also contributed to the decline. In terms of cost drivers, an increase in mining costs, variable costs, fixed costs, and depreciation and amortization have all had a negative impact on revenue growth. Specifically, mining costs increased by 16%, variable costs increased by 17%, fixed costs increased by 29%, and depreciation and amortization increased by 8%. These rising costs have put pressure on the company's bottom line, leading to a decline in revenue. The company is indeed generating positive operating cash flow. This is evident from the net cash generated from operating activities, which has been steadily increasing over the years. In 2025, the company reported a significant increase in operating cash flow to $234,258, up from $223,491 in 2024. This upward trend suggests that the company's operations are becoming more efficient and profitable, allowing it to generate substantial cash from its core business activities. The company's debt level has undergone significant changes over the past year. Initially, non-current liabilities increased by $16,000 in borrowings and a new liability of $6,000 was introduced on page 5. However, on page 23, it is noted that long-term borrowing decreased from $20 million to $0 in 2024, but the current portion of borrowing increased significantly from $0 to $50 million. This mixed trend is further reflected in the gearing ratio, which rose from 11.1% to 16.8%, indicating a substantial increase in debt level on page 41. On the other hand, interest expenses have shown varying trends as well. Net interest expense increased from $34,825,000 to $40,959,000 on page 12, but interest expenses decreased significantly from $8,359,000 to $7,731,000 on page 23. Despite this decrease in interest expenses, it is noted that the interest payment is higher than the interest receipt on page 42, suggesting a potential increase in interest expenses. Overall, while there are mixed trends in debt level and interest expenses, the company's debt level has increased significantly, which may have implications for its financial health and stability. The company's management has announced a major development in its business strategy. A significant acquisition has been made in UCC for $205 million. This move is aimed at expanding the company's exploration capabilities in copper and other non-ferrous metals. The acquisition is expected to bring new opportunities for growth and expansion into these key areas of focus. There is no significant activity to report on acquisitions and divestitures. The company has not made any notable purchases or sales of assets, businesses, or subsidiaries within the specified period. This indicates a stable and consistent approach to its operations and investments. The company's financial activities have been notable in two key areas. Firstly, the company has not paid out any dividends to its shareholders, indicating a focus on retaining profits within the business rather than distributing them to investors. Secondly, the company has engaged in share buybacks, utilizing $18.3 million to repurchase shares from the market. This strategic move aims to boost shareholder value by reducing the number of outstanding shares and increasing earnings per share. Concerns about inventory buildup and supply chain disruption have been raised due to significant increases in costs associated with holding excess inventory. The cost of inventories has risen by a substantial $51 million, indicating that companies are struggling to manage their stock levels effectively. Furthermore, the issue is compounded by transportation and stockpile losses, which have increased by $2.9 million. This suggests that not only are companies accumulating unnecessary costs due to overstocking, but they are also facing additional expenses related to storing and transporting these excess goods. These developments highlight the need for more efficient supply chain management practices to mitigate the risks of inventory buildup and disruption. That concludes the financial summary for Mongolian Mining Corporation. Feel free to comment below, and I will be happy to answer them when possible.